stocks have given me 3 years of performance in 6 months, which is a bit disconcerting. I have not yet begun to reduce my positions in the oil stocks, but people who are traders need very much to consider doing this. Exxon was easy to love at 95. It's much less easy to love at 180 or 185. People need to understand that, particularly the gamier oil stocks. People need to pay attention to their own portfolios. I bought the oil stocks because of deferred sustaining capital investments. The industry is underinvesting in sustaining capital to the tune of between $1 billion and $2 a day. That figure likely has gone up very recently as a consequence of deferred sustaining capital investments in the Middle East, which would be dangerous to make right now. These deferred sustaining capital investments impact the industry's ability to produce 2 years from now, 3 years from now, 4 years from now, and the production is difficult to bring back online, which means that in 2029, 2030, it's likely that we, as a consequence of unbalanced supply versus demand, ration by price, and the prices go up. That circumstance, I believe, would lead markets to go up in 2027, 2028. Instead, the markets went up in 2026.
The global energy market is currently sitting on a powder keg. As military conflict escalates in the Middle East, mainstream financial media is completely fixated on the daily price of oil. Retail traders are entirely missing the bigger picture. The true threat to the global economy isn't just localized conflict, it is the catastrophic vulnerability of the world's most critical shipping choke points, which hold the entire Eastern Hemisphere hostage.
If there is a reasonably timely, peaceful or semi-peaceful resolution in the Gulf, then the oil quotes come down and the oil stocks come crashing down. They will go back up, make no mistake, towards the end of this decade. But people need to decide whether they want to lock in sure gains now or whether they want to play the game over the next 2 to 3 years. It's worthy to note, too, Anthony, that it isn't just oil that we're talking about. Oil is particularly important. Many pundits point out the fact that 20% of the world's oil flows through the Persian Gulf. What they neglect to mention is between 40 and 50% of the world's export oil flows through the Straits of Hormuz. For takers in the eastern part of the Pacific Rim, particularly Korea, Japan, and China, this is a particularly critical source of crude oil. But the difficulty extends beyond oil. The biggest supplier of liquefied natural gas to the world is Qatar, and that is shut in. The world's largest supplier of liquid nitrogen and probably export nitrogenous fertilizers is also in the Gulf. 30% of the world's supply of helium is in the Gulf. About 25% of the world's capacity for refining aluminum is in the Gulf. Perhaps 50% of the world's export supplies of sulfur and sulfuric acid are in the Gulf. So the circumstance that we talk about is important in the oil business, but it isn't limited to oil. And investors and speculators across a wide variety of industries need to pay attention to this. The potential impact, if the war goes on in industries as diverse as petroleum refining and shipping, could be dramatic. I'm not suggesting that the war will go on. I'm not a geopolitical analyst. I'm not a military analyst. I'm really a credit analyst. Saudis are perhaps in the best shape of anybody to weather the storm, given the fact that they do have a pipeline that goes from their east coast to the west coast at Yanbu. And they do have the ability to reroute as much as 4 million barrels a day that currently goes through the Straits of Hormuz into the Red Sea. For other producers, Iran, Iraq, at least that portion of Iraqi oil that doesn't go north through Kurdistan into Turkey, and particularly Kuwait, this is an ugly circumstance. Well, that's interesting. You know, the oil price is just, from my viewpoint, too volatile to speculate. I'm not saying that the market is incorrect. The market responds to changes in perceived supply and demand really, truly in real time, perhaps greater than real time. It's very difficult to time or price that if you aren't in possession of lots and lots and lots of data. I'm an investor, not a speculator. And I notice that the increase, even as you suggest in the oil stocks going back in the 3 to 6 months time frame, has given me the gains in my oil stock portfolio that I had expected to have by the end of 2027.
As Gulf states furiously pull hundreds of billions of dollars out of U.S. treasuries in retaliation for the conflict, that stranded capital has to find a new home. The world is witnessing a historic de-treasurization event, and the money is flowing directly into the precious metals market. Based on the current chart consolidations, a massive, violent rally for gold in the immediate future.
And it's an interesting conundrum. I feel very comfortable owning the oil stocks for the balance of this decade. For people whose orientation is more short-term than mine, or people who entered the trade later than me, they need to decide whether or not they want to lock in these gains or they don't. Make no mistake, if if humankind resolves this conflict in the near term, however it gets resolved, the oil quote falls back into the low 60s, maybe even the high 50s, and the implied premium in the oil stocks evaporates temporarily. Make no mistake either, however, that this hiatus and this deferral of sustaining capital investments will impact the supply of oil, and it will impact the supply of oil this decade. If somebody wants illustrations of that, all they need to do is look at the state-controlled firms in Venezuela and Mexico, PDVSA and Pemex, respectively. These countries have had their national oil companies defer sustaining capital investments for as much as 20 years, often, ironically, in favor of politically expedient domestic programs like subsidizing gasoline and kerosene prices. The consequence of which is that PDVSA, as an example, has seen its productive capabilities fall by 85%, despite having the largest oil reserves in the world. Mexican production has similarly declined, although not to such a great extent. When you defer sustaining capital investments, it doesn't necessarily have an impact in 6 months or 12 months or even 18 months. But over time, it has a really dramatic impact. And that impact can't be turned around, as you suggest, Anthony, in months. It takes years. I'm not of a mood to reduce my Exxon holdings. I'm considering my Chevron and my Occidental holdings, whether or not to trim some. I should be trimming my basket of Canadian stocks. They've given me an awful lot very quickly. I haven't done so. Perhaps it's procrastination. And if I had a large basket of speculative stocks, I should be trimming those. Instead, I'm adding to them. There is one class of oil stocks that continues to be roundly hated. Those stocks are smaller microcap stocks, less than 300 million market cap, that are involved in conventional exploration rather than basin-centric or shale development plays, mostly in deep water offshore and mostly in emerging and frontier markets. The strategist in me says I should probably be taking profits on all of my oil stocks. The tactician in me is continuing to deploy capital in the one unloved corner of the hydrocarbon world, which is microcap, offshore, third world, emerging market explorers. I'm, as you know, a risk courter. If I'm confronted with asymmetric risk to reward parameters.
Yeah, okay, that's really interesting to hear. Thanks for explaining that. So, another commodity or commodities that have sort of had quite a lot of volatility are the metals, and especially at the start of the year, there's been a shift. I guess there's how would you explain that sort of the price action we've seen in the metals this year?
I think there's been a realization that almost irrespective of what we do, as an example in the copper business, that we're going to experience supply shortages. In the very, very near term, however, speculators betting on that are running into financing and carrying costs. So the copper market in the very, very near term is grossly oversupplied, and it's a catastrophe zone for speculators. Looking long term, 5 years or more, there's no doubt in my mind that we're going to experience a shortage of copper. So the outlook really depends on how you're playing the game, how much leverage you're using, and what your time preference is. I had the good fortune to attend Metals Week in London late 2025, and I heard one talk that really startled me. That talk centered around the fact that the major copper producers in the world have estimated that it will cost them $250 billion in constant 2025 dollars to maintain current production levels. The problem with that is that they're missing 100 billion of the 250 billion, and current production is at a deficit, which means just to maintain the current deficit rather than allow the deficit to grow, they need to invest $250 billion. And that ignores the fact that demand for copper on a global basis is growing by 2% compound.